Again, my view is inflation is going to be persistently higher. Our view is really that we're in a different world.
More recently, stock markets and US stock markets in particular experienced weaknesses, with both the S&P 500 and the tech-heavy NASDAQ index down in September. The CNN Greed and Fear Index is also expressing a pessimistic market sentiment, and long-term US Treasury rates continue to climb, adding to the forces that are pulling markets down. And Bill Ackman, founder and CEO of Pershing Square Capital, has now spoken at CNBC's Delivering Alpha Summit about the current macro environment, the investing approach he follows in such an environment, and one of his newest investments that is now the second largest holding for his fund and an AI beneficiary. So without further ado, let's have a look at what exactly he had to say and what you as a retail investor can learn from him. Alright, so as in my last videos, I've got a little presentation that is going to walk us through this video, and I would like to start by pointing out the long-term track record of Bill Ackman. So for those of you who are unfamiliar with his name, he's a value-focused investor and his long-term track record speaks for himself. You can actually check out the video that I did on the best investors of all time, and he will appear in that list. Because as you can see, over the very long term, since inception, Ackman was able to compound investors' capital at a rate of around 16%. And to be fair, what I pointed out in the bottom left corner is that his fund, Pershing Square Capital, actually trades at a significant discount to the net asset value of the equities in his fund. I think the discount has reached a level of around 40%. So in reality, he has actually performed even better. So what's on the agenda today? Here's the table of contents. So first of all, we will have a look at what Bill Ackman had to say about the current environment, the current macro environment, to be more specific. He then talked about how he handles this environment and how he likes to invest in, I will just say it outright, in a high inflationary, high interest rate environment. Then towards the end of his appearance at CNBC, he shared his secret to successful investing. And then finally, he also talked about one of his newest investments, which as of now is actually the second largest holding in his fund. So let's have a look at what exactly he had to say about the current investing and macro environment and what he predicts going forward.
I mean, are you still figuring that rates at the long end, the 30-year, for example, or however on the long end, are still going to go higher?
Yes. Look, I think there's, even in the relative short term, there are a number of reasons why rates can move a lot. We have probably the worst technical environment in our lifetimes for supply of bonds versus buyer bonds, right? We have China selling. We have Russia, to the extent they own any U.S. securities anymore, selling. We have Saudi Arabia selling. And we have an economy that is still strong and inflation, 3.5%, 4%, persistent. But, our view is basically you're not being paid enough to enter into a 30-year contract with the U.S. government at a fixed price. 4.7 or wherever it is now. It doesn't make sense in a world where we think structural inflation is north of 3% for the very long term. We went through this very unusual period with extremely low interest rates, where everything just got cheaper. And since the financial crisis, the effort of the Federal Reserve was to make sure we didn't have deflation. The aspirational goal is to get to 2% inflation, and then the pandemic, and trillions of fiscal stimulus, the psychological stimulus of being free to roam after being locked up. All of these factors coming at once kind of lit inflation, and we still.
All right, so Ackman just talked about the development of long-term interest rates and also the development of the 10-year and 30-year US Treasury. Yeah, and US long-term Treasuries in a way represent the risk-free rate. So basically investors can invest in long-term US Treasuries and there's very little risk of actually losing money. So if they do decide to invest in stocks, so in equities, they should demand a little premium to the rate that they can get by simply investing in US bonds. This is something that Warren Buffett has obviously also addressed. He's quoted saying, "We don't discount the future cash flows at 9% or 10%. No, we use the US Treasury." And obviously, if you're not familiar with that, in a way, economic law, interest rates basically act like gravity to all sorts of asset prices. So not only stocks, but also real estate and also other maybe more speculative assets. What you can see on this particular slide here is a visualization that Ashworth Damodaran has shared in one paper that he published on the topic of inflation and how to invest during high inflation. And basically I just highlighted with the arrow on the left that he also highlights that interest rates will highly influence the prices of other assets. And as Ackman has just outlined in the interview, he thinks that long-term rates are going to go higher, quote unquote, he said, through the 5% barrier. We're not there yet, to be clear. And he is actually putting his money behind what he is saying. In another video of mine, I've actually explained in detail how he is basically shorting US long-term treasuries by buying put options. So basically, Ackman's narrative is that we are going to see higher interest rates for a longer period of time. And obviously this will have, as I just said, a gravitational pull on stock prices all around the world, basically. Now, one last thing that I wanted to point out is that in the interview that I just showed you, Ackman also talked about the discount rate that he actually uses to value stocks. And he said that basically, regardless of the interest rate environment, he is using a discount rate of around 10%.
And also, again, historically, if you think about what is the value of a business? It's the present value of the cash you can take out of it over its life, discounted back at an appropriate interest rate. We were not discounting businesses back using 2% as an appropriate rate of interest. So we've historically, our discount rate we've used, just rough measure is more like 10%, 9%, numbers which discount the uncertainty inherent of investing in equities.
And let me just briefly explain why he sticks to 10% as a discount rate to value stocks, because I follow a very similar philosophy. Basically, the discount rate represents the rate of return that you demand from your investments. And during the low interest rate environment that we experienced over the last decade, I was not willing to reduce my hurdle rate. So I was not willing to be satisfied with, say, a return of 6 or 7% during a basically zero interest rate environment. No, I was still demanding 10%, and I was using 10% as my discount rate in my valuation models. And obviously, during a low interest rate environment, it will be much harder to find stocks that actually clear that hurdle rate. And in a higher interest rate environment, as the one we are in a way entering right now, obviously you will come across more investments that, as I just said, clear the 10% discount and hurdle rate. Okay, I think that's enough for macro today. If you have watched some of my other videos, you will know that personally, I don't believe anyone can sustainably correctly predict the development of macro indicators. There may be some exceptions, like Bill Ackman in particular has actually done very well with his macro hedges, but to be fair, he's quite articulate about the fact that for him those instruments are just hedges and not the main characteristic of his fund. No, his fund is made up of very few high quality stocks, and that's basically what we are going to take a look at next, because Ackman then talked about how he likes to invest during a high interest rate environment. So let's have a look.
You must be negative to the equity market. I mean, how could you have a positive view of stocks if you think that that's the outcome for bonds, yields?
Because if you own high quality, the key is owning businesses that have pricing power. Businesses that can do well in a world of, and by the way, many businesses can do well in a world of 3% inflation. The key is it's hard to manage a business in a world where inflation is volatile, or inflation is 8%, or the kind of crazy numbers. But many businesses can do very well in a world of 3% inflation. And the kind of companies we own, they're very much like royalties. So we own Universal Music, which is a royalty on listening to music. If there's music playing out there, Universal's getting a fraction of a penny for every song that's being streamed. Google's a royalty, if you will, on people advertising, on the web, right, or on YouTube. Restaurant Brands is a royalty on people eating at Burger King or any of their various concepts. Hilton is a royalty on people staying in hotels and eating and drinking and going to events. The beauty of these kinds of businesses is, actually inflation is ultimately their friend, right? As long as they can keep their costs, as long as their costs don't inflate as quickly as their as the revenues. And I think the nature of those, so I feel comfortable owning those kinds of businesses, even if inflation remains high. And
so Ackman was quite clear about his philosophy. He likes to invest, as I just said, in high quality stocks. And high quality stocks usually have a lot of pricing power. And pricing power may be particularly important during environments of higher inflation and maybe also higher interest rates. And let me just read one quote to you that kind of fits to that topic from the investors from Ensemble Capital. They said, one of the key attributes of a company with a moat is the ability to raise prices without overly reducing demand. And this is basically what I tried to illustrate with the graph that you can see on screen right now as well. And then they continued, but this relative advantage is diminished during periods of low inflation. It is during more inflationary periods where moaty companies with pricing power shine. All right, next let me emphasize once again that Ackman was speaking about, in a way, asset-light businesses. So he was stressing that many of the companies in his portfolio actually earn a royalty on other people's money and investments. And this is something that Warren Buffett himself has said as well. That's the quote in the bottom right corner. So he said, the best business is a royalty on the growth of others that requires little capital itself. So requiring little capital, basically that is describing a so-called asset-light company. And I have included another paragraph from Buffett's writing in which he talks about exactly those businesses. Let me just read parts of it to you. So he wrote, and that fact, of course, has been hard for many people to grasp. For years, the traditional wisdom, long on tradition, short on wisdom, held that the inflation protection was best provided by businesses laden with natural resources, plants and machinery, or other tangible assets, quote unquote, in goods we trust. However, it doesn't work that way. Asset-heavy businesses generally earn low rates on return, rates that often barely provide enough capital to fund the inflationary needs of the existing business, with nothing left over for real growth, for distribution to owners, or for acquisitions of new businesses. In contrast, a disproportionate number of the great business fortunes built up during the inflationary years arose from ownership in operations that combine intangibles of lasting value with relatively minor requirements for tangible assets. All right, so to sum up, ideally during an environment of high inflation and also high interest rates, you want to own businesses with pricing power that can earn high returns on capital, basically regardless of the environment. Yeah, and as I just said, asset-light businesses in particular are particularly interesting. And what I will say, later in the video, we will talk about Ackman's new investment, and that business in particular is very asset light and thus enjoys a lot of so-called operating leverage. Now, how do you actually identify businesses with pricing power? This is maybe easier said than done because identifying businesses with pricing power requires a qualitative understanding of the businesses. However, what I will share with you in this video is a checklist that the Twitter user InvestQuotes shared on Twitter. So please make sure to give him a follow. And his list consisted of 5 questions. The first one was, does the company have high customer retention rates? Obviously, the higher the retention rates, the higher the pricing power. The second question was, does the product make up a low portion of the customer's budget? Again, if it does make up a low portion of the overall budget, the customer will be less sensitive to price increases. Thirdly, is the product mission critical? Obviously, the more mission critical, the more pricing power for the provider of that product. Fourthly, are customers profitable? Obviously, if you are selling to other businesses, you will have more pricing power the more profitable your customers are because they care less about minor price changes. And lastly, does the quality of the product matter more than its price? Again, I think this one is quite obvious. Now, what I will say is that in a high interest rate environment, you do not only want to own businesses with pricing power, but also businesses with low debt. This is actually something that I talked about in private with Andrew, who recently appeared on, I was about to say my podcast, but it's not really a podcast, on my channel, and we had a 1-hour interview about his investing philosophy. And in our private discussion, he was pointing out that actually many businesses carry a lot of debt, and the higher interest rate environment may pose a problem for them because they may have to refinance some of their debt going forward, because historically they were basically just paying off their debt by issuing new debt at lower interest rates. But obviously this model doesn't work anymore. And I've tried to illustrate this with one example here. If we look, for example, at Dollar General, I was just taking a brief look at this company's balance sheet. We can find long-term debt worth $7.3 billion US dollars. Roughly 3.5 billion of that must be paid off or refinanced over the next 5 years. And Dollar General pays between 3.8 and 5.2% in interest on that debt. And this amounts to, if we just assume on average an interest rate of 4.5% on those debts, this will lead to interest payments of 157 million US dollars a year, which represents around 8% of the net income. And if we take a look at the interest payments on all of the debt that Dollar General had to make in over the last 12 months, this amounts to 295 million US dollars. And if we do not compare it to the net profit, but the free cash flow generated by Dollar General, which was historically low for that business, I have to say, but the free cash flow generated was only around 90 million. And as you can see, the interest payments already represent a significant chunk of free cash flow. And if we now assume that they actually have to refinance the debt at a higher rate, we can imagine that this is going to have quite an impact on the business. And as I point out in the title, so interest expenses obviously will eat into businesses' profits. However, this is only true if the business does actually carry a lot of debt, which is why I prefer to own companies with low debt, especially in a high interest rate environment. All right, let's move on to the next clip from Ackman, in which he shared one of his investing secrets.
And then the famous Herbalife. But since then, all we do is we own really, really great businesses. And if you want to be a successful investor over time and you find a handful of great businesses, doing nothing but owning them is an amazing strategy. And it's underappreciated, if you will, as a successful way to make money.
All right, so if you have watched some of my other videos, you will know that I'm a big fan of Terry Smith too, whose investing philosophy can be characterized by 3 items: invest in good businesses, don't overpay, and then do nothing. And this is apparently a philosophy that Bill Ackman ascribes to as well, doing nothing. I've tried to visualize this in this chart here. I think one of the hardest part of investing successfully is actually saying no to pretty much every idea that you come across, doing nothing most of the time, and just letting the businesses you own, so the high quality businesses you own, do the hard work for you. This is, by the way, also what I try to teach the people that I am mentoring right now. And if you want to get mentored as well, feel free to reach out to me. Owning a portfolio of super high quality businesses brings a couple of benefits. So as we just outlined, they tend to do well regardless of the macro environment. You will have to trade less frequently, which will lead to lower expenses in trading fees. There will be lower transaction costs. You will generally have more time, as we just shown. You are best off if you do nothing most of the time. And I've listed some of the other benefits of owning high quality businesses at the bottom of this slide. So once again, if you want to get mentored, feel free to reach out to me. I'll put a link to the website that I have set up in the description box down below. Now, finally, let's have a look at one last clip from Bill Ackman, in which he talked about one of his newest investments, and that investment is Google. And just a disclaimer right here, I'm a Google shareholder myself ever since 2020, since the pandemic, when Google was actually trading below $1,000 a share. So with that being said, let's have a look at what he had to say. And after that, I will add a couple of more thoughts on the Google investment as well.
Alphabet is one of your more recent investments, is that correct?
Yeah, we bought it late last year, early this year.
How much did that have to do with AI?
It had a lot to do with AI because AI was the reason why the stock was cheap, right? ChatGPT was launched, incredible, game-changing kind of product, and Google really fumbled their offering. And so people said, oh my God, Google's way behind on AI, and the stock sold off to 15 times earnings for one of the greatest businesses in the world. And we did a fair bit of work, but Google's been almost a decade. They bought DeepMind, huge, spending billions and billions of dollars on AI. It's a company known for hiring great engineers. and you could certainly presume they were in a pretty good place on AI, but they're again very different from a startup. They took a much more cautious launch approach, and then kind of fumbled an early demonstration, made people think they were behind, and Microsoft and ChatGPT would sort of, if you will, OpenAI would eat their lunch, and it led to a very mispriced stock. And then we've bought more in the 120s. It's our second largest investment.
Alphabet.
Yeah.
So what you can see on screen right now is basically the Pershing Square portfolio as of the second quarter of 2023. And right here, Google already makes up around 13% of the overall portfolio. On the next slide here, I have shown you basically when Ackman started buying Google stock. I think he said in the interview he was a buyer at around $94 a share, which obviously turned out to be a very lucrative price for Google, because I think ever since the stock is up around 40%. But he then continued buying in Q2. I've tried to illustrate this here. So in Q1, he was buying around 2 million shares. He was then increasing that position by around 50% in Q2. And at the CNBC interview, he actually pointed out that he and his fund continued to buy in the third quarter, which has now led to the fact that Google is the second largest holding in the Pershing Square portfolio. Now, what I've done is I have actually taken a look at the Pershing Square shareholder letter, because in it, Ackman obviously also laid out his investment thesis for Google. Let me just read out the most important paragraphs from that letter to you. Earlier this year, we initiated a position in Alphabet, the parent company of Google. We believe that Google is one of the world's greatest businesses with deep barriers to entry and massive network effects, underpinning its core search business. After having closely followed the company for many years, we had the opportunity to acquire a stake in Google at a highly attractive valuation, as misplaced concerns over its competitive positioning in AI overshadowed the high-quality nature of its business and its strong growth prospects. Google is the dominant leader in the fast-growing digital advertising market. Google has 85% market share in search, and along with YouTube, an approximately 50% share of the digital advertising market. With higher and improving returns on investments, we expect digital ads to continue to take market share from traditional ad formats like TV and print, and increasingly drive the total advertising market growth above its historical trend. I'll stop here. Another pillar of his investment thesis is the cloud business of Google. Here he wrote, similarly, in its cloud business, Google is a top 3 player in an oligopolistic market that is in the early stages of a multi-year shift of IT workloads from on-premise to cloud and hybrid cloud solutions. These powerful secular tailwinds have enabled Google to grow overall revenues at a high teens compound annual growth rate over the last 5 years, which should continue to support near double-digit top-line growth in the coming years. And then, as I said in the beginning of the video, in the last paragraph, basically, Ackman is pointing out the asset-light nature of Google's business. He's pointing out the potential to increase profit margins going forward. He's referring to the fundamentally fixed cost nature of Google's business. And I think he on the next slide, he was also talking about the operating leverage. Yes, that's right. Okay, we'll obviously not read everything to you right here, so feel free to pause the video right here to read the rest of his Google investment thesis for yourself. What I will discuss, however, is that not everyone seems to agree with Bill Ackman here. In particular, Brett Gerstner from Altimeter decided to publicly disagree with Ackman. At the Delivering Alpha Summit, he was actually discussing Google too, and I will show you a clip of that in just a second. But basically, unlike Ackman, he does believe that the emergence of ChatGPT will fundamentally change the core business of Google, which is of course search. And he points out that the economics of the search business, which made Google historically such an attractive investment, may change, because obviously searching with artificial intelligence is fundamentally different. Most likely, if we fast forward 10 years, you will not get a list of tens and hundreds of links that you can work your way through, but most likely there will be one answer, and it's still unclear how this new way of searching for information online can be monetized. Personally, I tend to agree with Ackman here, because I'm pretty sure that Google will keep its position. They also have a very strong position in AI. Their BART solution works actually fabulously well. I can only urge you to try it out yourself. And I'm pretty sure that Google will also find ways to monetize this new way of searching. But let's have a look at what Brett Gerstner actually had to say.
Let's say that Google with Bard is just as good as ChatGPT. So then the question is, will Bard have the same economics of Google search? And what I'm arguing is, even if they're competitive, even if Bard is the best, they're not going to have the same monopoly profits in the age of AI as they had with search.
All right, and just to add with that, here's what Brett Gerstner actually wrote on Twitter. He said, 100% of Google's profits come from their monopoly in consumer search. As we shift to answers, actions, ChatGPT, Meta AI, Bard, PI, and away from 10 blue links, Google is unlikely to keep the same monopoly profits. ChatGPT is the new AI verb, classic innovator's dilemma. And later he wrote, Bill is right, Google is still investable and cheap and will also have some offsetting benefits due to AI cloud, but the discount one has to apply to their continuing dominance or tax on the internet. Consumer search has gone up for the first time in 20 years. And I think what he's basically pointing out is that the range of possible outcomes for Google in the search business has widened. And I think one has to agree with him. It's not entirely clear how search will develop over the next 10 years, especially with the rapid pace at which AI is improving and innovating. So I guess it remains to be seen. However, personally, I think the valuation of Google is not particularly demanding, and Google still remains one of the best businesses in the world and obviously has other potential growth drivers for the future as well. All right, with that being said, we'll wrap it up here for today. Let me know if you enjoyed the video in the comments down below, and I'll see you in one of my next videos.